Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is William Bronchick. Thanks for being on the show, William.
Thank you. It's my pleasure to be here.
Yeah, I'm happy to have you on the show. I'm looking forward to this conversation. And William is the host of LegalWiz.com and is a nationally known attorney, author, entrepreneur, and public speaker. He has been practicing law and investing in real estate since the early 90s, having been involved in thousands of real estate transactions. His best-selling book, Flipping Properties, was named one of the 10 best real estate books of the year by the Chicago Tribune. He is also the co-founder and past president of the Colorado Association of Real Estate Investors and the executive director and founder of the College of American Real Estate Investors. So, William, thank you again for your time being on the show. Give the listeners a little bit more about just who you are and maybe where you're located, and let's dive in to our topic today.
Great. Originally from New York City, lived in Colorado for 26 years. Mentioned earlier, I started one of the biggest real estate investor associations in the country, and just founded a new one called Colorado Landlords Association, which launches in January, which will be focused on people with anywhere from single to big multifamily apartment buildings, investing in and managing and financing and putting together deals. So I'm a deal maker. Most attorneys will give you just enough advice to keep them from getting sued for malpractice. That's why they say lawyers are destroyers. They kill deals. I'm not that type of attorney. I figure you're an adult. If you understand the risks, I'm going to explain them to you, and it's your choice.
I understand. Okay. So, what I like though is like you've been in real estate for a really long time. You're an investor yourself. You've done syndications as well, and so it's nice to have an attorney on your team that's an investor as well and has done lots of different deals, not somebody that's just looking at the legal jargon, on the documents, but you've actually been out in the field yourself. So I like that expertise that you bring. And then, but, I think today we're going to talk about maybe a recent syndication or a couple syndications and really get into some creative financing that you've been a part of. And so maybe get us started on a recent deal where we can dive into how you've worked the creative financing.
Yeah. One deal, I had a seller who had an existing Freddie Mac low interest rate 30-year loan. He was asking about $6.5 million. He owed about $3,750,000, and he had agreed on a price of $1 million above that, $4.750. One of my clients was negotiating with him. And, that's a pretty good deal from 6.5 down to, 4.750. But I said, ask him if he's got an existing loan, what are the terms of it and everything. We found out it's a low interest rate loan. It isn't adjustable, but it was currently at 3.75 or something like that, adjusting every 5 years on a LIBOR. And I said, well, ask him if he's willing to wrap the mortgage, meaning we basically give him $1 million cash, and then we take the property subject to his mortgage and just pay the bank. Now, though we looked at the mortgage, and his attorney and I said, if we transfer this, there's an acceleration clause, the bank could call the loan due. So I asked the seller's attorney, is he owned in an LLC? He said, in fact, he does. I said, is he the sole member? In fact, he is. I said, okay, how about we transfer the membership of the LLC to our LLC and work our way around the acceleration clause? And we actually structured as such that the lender signed off and said, yeah, that's okay. You could do it that way. So basically we ended up giving the seller about $600 at closing, and then convinced him to take $400 later. And then basically wrapped around his existing mortgage of $3,750,000. The appraisal came in at 7.1.
Wow. So he was first asking 6 million, but then he had come down to $1 million over what
Right.
he owed.
Mortgage.
Right.
Yeah. And then
Yeah.
not only that, but the appraisal came in, 7-1, pro forma, and it was close. It was about 75% occupied. But screaming deal.
That's a good deal. Yeah, that's a good day right there.
Yeah.
And instead of assuming the loan, you transferred the membership.
Yeah. Yeah.
And even went to
Mortgage said if you don't do the following, then we won't call the loan. Or if you do the following, we will call the loan. So the seller's attorney and I just said, well, let's just do around what it says you can't do. And that's how we structured it.
So, who would we, if we were in in those shoes there and we're trying to figure out, okay, should we assume this loan? What are maybe some common issues or problems you see people that happen when they're trying to assume a loan like that?
Is the interest rate good? What's the amortization, 15, 20, 30? Is there a balloon? Is it adjustable, and how often does it adjust, and what's the cap? How high can it go? Is there a floor and a ceiling to the loan? And you can assume, go to the bank and say, here's my credit, here's my financials, and just get permission. And that may be worth it. Another deal it did recently was a 18-unit apartment building in Colorado that had 2-bedroom, 1-bath apartments that we wanted to split into 1-1s, sort of micro apartments, but not, maybe 500 square feet each, because they were 1,000. So if we split them up into 2, we double the number, and the parking lot could handle twice as many people. One of the attractive things was there was an existing Freddie Mac mortgage, 30-year fixed at 3.1%.
Wow.
Yeah. So we were going to give the seller basically about $900 cash, assume the loan, and then spend about $600,000 converting the 18 units into 36 units. And it would turn it from a 6 cap into basically an 11 cap, which would be quite substantial profit. The investor who was putting up the money, we said, we're going to form an LLC and you'll be one of the members and syndicated as follows. He didn't want to do that. For some reason, he wanted to be a lender in second position, which doesn't really make sense to me, but that's what he wanted. When we went to contact Freddie Mac, they said, nope, no seconds. No second lien position. So we went back to the investor and said, please, don't be foolish. This is a great deal. Just be a part of our LLC, and we'll be co-owners, co-members of the LLC, and you'll be an equity owner. And he just didn't want to do it, and Freddie Mac wouldn't let us put a second loan behind theirs, and the deal fell apart, unfortunately.
So why were they selling, or why was that deal for sale?
I'm trying to remember. I think the seller was just moving on. They had bought it a couple of years ago, and they got it to full occupancy and market rents, and 6 cap, 5 cap is about the going rate in Denver for a building like that. But we figured if we can convert it from 18 to 36 units, smaller, obviously, but we would get almost double rent than we were getting from 18 units that were bigger. So the parking lot was substantial and would handle the extra parking, so zoning wasn't a problem. And we'd have to upgrade some things, some of the electrical and plumbing to handle the extra units, but the numbers made sense.
So, a property like that, how long, you said it was 30-year debt. Is that right?
Yeah, it was a 30-year, 3.1%, 125 or something like that.
Yeah. And so how far into that loan, was this seller?
4 or 5 years.
Wow. Okay.
Yeah, that's good. One of the advantages of assuming a loan is, of course, as you're implying here, if it's a 30 or 20-year loan and they've been paying down for 4 or 5 years, now you're starting to chip away at the equity a bit, where if you start over with a new bank loan, you're all interest.
Any experience or previous deals recently with using bridge debt?
Yes. I just put together a syndication for a client of a adult living facility in Florida, and they're going to build it. It's just a piece of land, and they got bridge financing lined up for 18 months to build it, and then they have the same bank will convert that debt into permanent financing.
Okay, so maybe you could tell us a little bit about bridge financing, just in case the listener's not familiar with that. I know you said this was new construction, but
Right.
there's other uses as well. But could you just
Sure.
elaborate a little bit?
Hard to get a 20 or 30-year loan on new construction. Now you could put up all cash for that with partners or private lenders. But the rates you might pay are pretty substantial. It's almost hard money rates, which could be 12, 13, 14% and 4 points with a 6 month to a year balloon, which is not good. A lot of lenders, commercial lenders, will do what they call bridge or gap or mezzanine financing, which is usually a 1 to 2 year balloon. And you're looking at probably 7 to 9%, a couple of points. Probably going to be interest only. And that's fine if you need to do what you need to do to get it into the condition that the building qualifies for long-term financing. So if you're getting a building that is half empty, you're not going to get a lender who's going to give you a long-term loan on that. So you need gap funding or bridge funding to maybe fix it up and raise the rents a little bit and fill up the place till it's 80% occupied, and then it's a lot easier to get financing long-term.
Yeah. So if we had a property that was, say, 60% occupied, but we, maybe that was because of mismanagement or some other issue that we knew we could fix, we're going to have to get bridge debt, correct? And so that'll, until, like you said, until it's over 80%, at least 80%. So it's considered stabilized, and then we can get more permanent type debt.
Right.
So, bridge debt, it's an older property or obviously new construction, like you mentioned. I know you use the word like mezzanine. Could you just tell us what that is?
Well, it's just different names for the same animal. It's bridge debt, gap debt, quasi hard money loan, or whatever you want to call it. It's not your permanent loan. It's a temporary loan to do what you got to do to get the thing either built or filled up or reconstructed or managed better so it'll qualify for the better 30-year fixed or 20-year, 5-year fixed rates that are available out there. Maybe you do it as temporary financing if you're lucky enough to get an FHA loan, which amortizes 35 years or more at very low rates. But those loans can take 9 months to a year to get. In the meantime, the deal's there. You might have to pay a little more an interest rate and cost for that short-term loan, but in the long term, it'll pay off.
What are the, say, cons to doing in a mezzanine or bridge debt?
Well, first of all, your cash flow is going to be tight. When you're paying 7 to 9% interest, maybe sometimes even more, it's going to affect your cash flow numbers, very substantially. So you could expect that you're not going to make much cash flow, maybe even negative the first year or two, while you get the thing turned around and repositioned. So your investors have to have enough cash to carry that. There's a balloon on these loans. So if there's let's say a 2-year balloon and you haven't turned the thing around in 2 years, you're going to be in trouble because that balloon is due and they'll foreclose and take the property from you.
So you better have a good business plan, right?
Yeah.
So what about, the credentials that we need to be able to get something like bridge debt?
Bridge debt is easier usually to get than long-term financing because it's a lower loan to value. So instead of getting 80% loan to value, and there's even some lenders now doing commercial debt at 85, 90, which is almost unheard of before, it might be more like 60%, 65% loan to value. So in that sense, the lender doesn't have as big of a risk as lending 80% loan to value. So they're a little softer on qualification. They're more concerned, can the building support it? Do you have the experience to turn it around? And does your plan make sense so that you can get out of this loan before the balloon comes due and refinance it or sell it?
So what about like floating rates?
Well, again, in the short term, I'm not that concerned with it. So if it was 7 and market interest rates went up and then it becomes 8 after a year, this is all short-term financing for a year or two until you get the building repositioned to a point where you can get long-term financing or turn around and sell it. So floating rates long-term can be dangerous if you plan on keeping it long-term. If your goal is to keep it 5 years and you've got a 5-year fix and then it goes to an ARM, that's fine. That's fine if you only plan on keeping it 5 years. But if you if you want to keep something a long time, you're probably, given the uncertainties in the world global interest rate market now, interest rates are very low, of course, but you just never know what Trump does to China and what happens to interest rates, and et cetera, et cetera. So I would recommend getting a fixed rate loan or getting something fixed for as long as you can.
Yeah. So I know there's a lot of listeners who are trying to get to that first deal. Maybe they've done one deal, or they're hoping to get that non-recourse, right, agency debt. And so, help us to, I guess, help them know what they need to be qualified for that first agency debt, and maybe some ways to help them to be more qualified for the next one as well, moving forward.
Well, first, I would encourage someone who's just starting out to maybe find a deal where you can get seller financing or partners to put up all the cash so you don't have the complication of that. You may have to bring in a partner who has those qualifications to qualify for the loan. It's different than a single-family home where they're looking at just your credit score and your debt-to-income ratio. They're looking at your experience. They're looking at your total net worth relative to the loan. They're looking at the management structure and the income and the cap rate of the property, and what's your plan for turning it around. So there's a lot of factors there. In some ways, it's easier to get millions of dollars in non-recourse commercial financing than it is, on a single-family house. In some ways, it's true. But if you don't have the net worth that they're looking for, or the experience they're looking for, maybe bring in a co-managing member of your LLC to be, 20% owner, 25% owner, and have their qualifications for the loan. And hopefully their experience as well, so they can help guide you through it.
So do we have to have somebody that's signed on agency debt before?
Yeah. A lot of times they make you sign on personally on a guarantee on a loan. The smaller the loan, the more they want to guarantee. Oddly enough, $40 million is easier to get non-recourse than it is, $4 million in many cases. But again, if it's a deal where you're borrowing a lower loan to value, let's say, 65, 70% as opposed to 80%, and you're getting more partners in to bring in the cash down payment, you may make less, but your risk exposure is lower, because if it does get foreclosed, the chance of a deficiency is pretty slim when you're only borrowing at 65, 70% LTV.
Would you advise that new person, maybe this is their first deal using agency debt, and they have somebody else that's bringing the balance sheet or the liquidity, and then maybe somebody else is bringing the experience, or maybe that's the same person, but it's their first agency debt. Would you advise them to sign on the debt as well so they gain experience?
Well, signing on the debt is nothing but a liability. There's no upside to it, other than maybe you could say to a lender in the future, here's what I did. But I don't know if that gets you any points just because you signed personally. So if you can not sign personally, that would probably be a good thing for you in case it goes bad, and you don't want to be on the hook, because borrowers are jointly liable. So that means they're going to go after the one with the deepest pocket, regardless of how many people signed on it. If you have to, if they require it and the numbers make sense and it's a smoking deal, I don't see anything wrong with that. But if it's a high-risk deal, if you're going into a boarded-up building, and you're guessing, what market rents are going to be in 2 years and filling it up, and you're going for 80% financing, that's very risky.
So, let's see. When doing a deal like that, though, and you have other people, I'll say, and I get this question often from passive investors. Maybe they're new to the syndication business, and even last night I had somebody ask me, well, wait a minute, if I'm a limited partner, if I'm a passive investor, how much liability do I have? So and let's use that same scenario. If we have agency debt, non-recourse, and let's say the deal goes bad. What happens, or what kind of issues could the passive investor see, and also the general partnership see?
Well, the passive investors have virtually no risk. If you're not a managing partner, general partner, or in the case of an LLC, managing member, and you don't sign on any debt, and you don't manage the property, and you're not participating in any of the major decisions, then there's no liability for you, because liability is based on the failure to do something you're supposed to do. That's where the managing partners potentially have liability. But if you're just a passive investor putting up money and you're not participating in the day-to-day operations, and you haven't signed your name on any loan, your risk is very, very, very low. It's not much different than buying stock in Google.
Good.
I mean, there's a chance you can get on the hook. There's a chance, but it's a very low one.
That's what I told her. And I also added that she needed to talk to her attorney, that I was not an attorney. But on the general partnership side, obviously there's a lot more liability there.
Sure.
Can you speak to that?
Sure. In a limited partnership, a general partner has liability, which was why most general partners are corporate entities. But even so, if you're a managing member for an LLC, technically you're not liable under state law for decisions you make in the ordinary course of your dealings. But there's so many exceptions that are carved out for that in the case law, where you could be held personally liable for what's called piercing the corporate veil, especially if it's a small company, and especially if you do something really wrong and someone's really injured financially or physically. So there's a lot more risk for those. Plus, you have potential liability to your investors, who can always come back and say you misrepresented, or you mismanaged, or you took the money and used it for things you weren't supposed to, and so forth.
Yeah, I was speaking with another operator this morning, and he was telling me about this group who raised, I don't know how many hundreds of millions over a longer course of time, but found out that, or they were found out that they were doing some highly illegal things, and now many are in prison and have received all kinds of death threats. And I mean, it's a big deal, so we take this very seriously, no doubt about it. And
right. You might want to insist on, well, if I were going to be a managing member on a big deal where I could expose myself to potential liability, I would insist on the company buying me errors and omissions insurance as a managing director of the company. So if the shareholders sue me and allege wrongdoing, I have lawyers' fees covered, at least. And unless I've committed something grossly illegal or grossly negligent, the insurance is going to cover that. As an investor, you may want to insist on that too, because you want to have a deep pocket to go after. It doesn't matter if you sue the directors or the general partners if they're in jail and they can't pay the debt. You want to have a policy to go after.
So errors and admissions insurance.
Errors and omissions.
Omissions insurance.
Yeah.
Awesome. And where would we go to get insurance like that?
That's a fairly specialty type of insurance. People who would insure lawyers, real estate brokers, corporate directors, that's the type of insurance policy it is.
Okay. All right, William, just a few more questions before we run out of time. And so what's been the hardest part of the syndication process or business for you?
Ooh. In the beginning, I think my mistake was not raising enough money. It's better to promise less and have more people in the deal than to promise more and say, oh, by the way, we're running out of money, we need more. You never want to, it's not saying never, but it's a bad idea to underestimate your cash flow needs and have to go back to your investors and say, you got to pony up more money. It's better off, raising more capital and promising a lower rate of return for investors. I think that's one of the things I learned early on. And also make sure you have people invest who have enough experience and sophistication that they understand the risks involved. And if someone's putting up 100,000, it's their last 100,000. That's going to be someone who's going to torture you every day about their money and their investment. You don't want an investor like that. You'd rather have someone who's worth 10 million and take $500,000 because they can afford it to lose it and they're willing to take that risk.
So how are you preparing for another potential downturn?
Buy more. People thought I was crazy, but between 2019 and 2011, I was loading up on properties because they were cheap. It was hard to even get them filled and the rents to even barely break even. And we suffered for a few years, but look what happened over the last 6 or 7 years. Property values doubled and tripled in some cases. Rents doubled. So it's a payoff. There's money to be made in every market. A falling market is hard unless you could see your plan through the end of the rainbow, down through the bottom, and then up back up again. And if you could hold on long enough, real estate is a lot of how long can you survive? In the long run, it almost always goes up in value, and so do rents. But can you survive the ups and downs in between is really the case.
And what's a way that you've recently improved your business that we could apply to ours?
Let me think about that one for a minute. I would say just learning from other people's experience has been good. Meeting other players in the business that can maybe bring some knowledge or experience to the table for you, and maybe you take less of the deal. So especially if you're a newbie in this and you want to do a deal, maybe bring in a partner and give them 60% of the profit because they've done it 30 times. Takes your risk level way down and your comfort level way up.
What's your best advice for caring for investors so they want to come back to the next deal?
For caring for the investors, well, you want to under promise and over deliver. I found that I've looked at deals where the cash on cash return, if I sliced it up one way, might result in 15 to 18%. Some people don't believe that. They think it's a scam. It's too high. So I'm better off slicing it up so I take more and I give them 11% and they believe it more. And if I end up giving them 15, they're thrilled.
What's the number one thing that's contributed to your success?
Learn from every mistake. Everything's a learning lesson. If you make a mistake and you lose money, it's just an education. Don't give up. You'll always have obstacles in your path. You'll always make mistakes. Try to learn as much as you can and employ the expertise of others who are more experienced. But there's risk in all investing, and you got to be willing to take the chance and stick to it.
And how do you like to give back?
I write hundreds and hundreds of articles. I do hundreds of videos on YouTube, and I've written 6 books on real estate investing. So that's my way of sharing my expertise and knowledge with other people so they can follow the path and use real estate to create their retirement or lifestyle that they choose.
Awesome, William. I appreciate your time and you sharing your expertise. It's been a great show, and just you diving into some creative financing and a couple of deals that you talked about. Can't thank you enough. But tell the listeners how they can get in touch with you and learn more about you, and even find your YouTube channel.
Yes, my YouTube channel is just youtube.com/my last name, Bronchick, Bronchick. My website is legalwiz.com. Without the H, Wiz, W-I-Z. Legalwiz.com, where I have hundreds of articles on commercial and residential investing, videos, podcasts. I have a podcast as well on Apple iTunes and streaming on my website, and tons and tons of videos on YouTube.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.